Hello everyone and welcome to today's Technology Tuesday, hosted by Out of the Box Technology. We are excited to bring you these free webinars that feature third-party apps, tips and tricks from in and outside of QuickBooks, and hot topics that our industry is encountering. My name is Jennifer and I am in Business Development and Customer Relations here at Out of the Box Technology, and I'll be your moderator today. If you have any questions during the presentation, please feel free to send those over to me via the chat question function on your GoToWebinar control panel, and we'll take care of those questions at the end of the session. A little bit about Out of the Box Technology, if you're not familiar with our company. We are QuickBooks consultants, basically, at the end of the day. We have a whole team of consultants that can do training, integration, hosting, and setup for QuickBooks. We have a whole bookkeeping staff that will work to do bookkeeping services with as little or as much involvement as you would like. We also have a great development team that does website design, custom app development, and data migrations. Two of our products that we're really proud of are some apps that we developed. First is our event app. That is a full conference registration and event app that is used for several of our clients with a lot of success for their shows. The other is Recur 360, which was one of Intuit's top 10 best new apps for 2017. We were really excited to be a part of that opportunity with Intuit. Recur 360 is an advanced solution for recurring payments, invoicing, and collections. But enough about us here at Out of the Box Technology. Today we are so excited to welcome Avalara. We have Mark Ratcliffe with us today, who's going to deliver a really great presentation that's kind of a follow-up to one that we did earlier this year on sales tax compliance and diving a little bit more into Avalara. So at this time, I'm going to hand things over to Mark to get us started.
Thanks, Jennifer, and hello, everyone. And I just want to take a moment to thank Jennifer and everyone at Out of the Box for having us. Again, my name is Mark Ratcliffe. I'm one of the national sales managers here at Avalara. I don't know how many folks may have been on a prior presentation that we did around sales tax compliance. So at a high level, we're a software company, a technology company that specializes in sales tax compliance. Automating that process, making it more streamlined and efficient for companies. To give you some background on us, we've been around for just about 15 years. We're headquartered in Seattle, Washington, but I actually work in our Durham, North Carolina office. I've been with Avalara for just about 4.5 years now, and I mainly work on a team here that specializes in preparing solutions for small and medium-sized businesses. So a lot of the companies that my team specifically works with will use platforms like QuickBooks. They may be selling online through their own website using some type of e-commerce shopping cart. They may also potentially be marketplace sellers, so selling through platforms like Amazon, eBay, Etsy, so on and so forth. And depending on the number of platforms in play, companies can have very different sales tax compliance footprints in terms of where they're obligated to be registered, collecting sales tax, filing returns. But I won't get too far into the weeds on this slide, just to let you know that we are a technology company specializing in sales tax compliance. We integrate into about 600 current platforms. So I mentioned QuickBooks and a lot of different shopping carts, but we've also got integrations into a wide range of ERPs, such as Sage, NetSuite, SAP, Oracle, so on and so forth. And we live in the cloud, which is part of the way that we're able to offer a real-time solution that I'll get into a little bit more in just a few minutes. So let's talk about kind of the agenda for today's presentation. I want to start with sort of an overview of really what is sales tax, right? Why should I be concerned about it? What does it mean for a company to be compliant with their sales and use tax? And we'll talk specifically about why that is a complex idea, right? Why is sales tax hard in the U.S. specifically? What are some additional challenges beyond just knowing that there's a rate for this county or a rate for this city, for example? And many of you may have heard of or are familiar with the recent Supreme Court decision related to Wayfair versus South Dakota. Now, it's been 3 or 4 months since that happened, but we have seen some waves in the sales tax compliance space. There are some significant changes that companies, especially folks that are selling a lot of volume into states outside of where they may be based, there are some significant changes in play, and we want to provide some education around that decision and what it means for companies. And finally, what type of solution would be good for your company, right? As I mentioned previously, a lot of our customers will have a filing obligation in one state. You know, that they may be in a state like Massachusetts where there's a flat rate for sales tax. There's not a lot of complexity there, right? They may sell some tangible items. There may not be a wide footprint, right? But other companies may say, hey, I have to collect and file sales tax in 10 states or 20 states or 30 states, whatever it may be. And the products and services that companies will sell also vary greatly in their taxability, right? So if your company sells something like an ink pen or maybe a broom, that usually falls under the category of general tangible property. It's usually fully taxable. There's not a lot of complexity there. But if your company sells something like software, which is what we do, or maybe you sell medical devices or nutritional supplements, or you're a service-based company, for example. So maybe you service and install HVAC units, for example. These are all types of products and services that would have varying taxability from state to state. Finally, we'll give you an overview of what we do, what our solution looks like, how it can integrate potentially with QuickBooks and many other platforms to automate not only calculating sales tax, but determining the taxability of the products and services that are being sold. And then finally, we'll open it up at the end for some questions if those arise. So the first thing I want to start with is, I love this image. This is obviously an iceberg, right? When I ask folks just at a very high level, what do you think about? What comes to your mind first when I say sales tax or I say sales tax compliance? And 99% of the time, the answer is, oh, it's a certain percentage of tax that I'm going to pay on, you know, some purchase that I'm making, right? I'm online, maybe ordering something from Amazon, or I'm in a store somewhere purchasing a new jacket because it's, you know, winter's coming and it's gonna be cold. So that the rates, right? The percentages, the calculation. That's really what first comes to mind. But you know, when you think about sales tax compliance as a whole, and this is where the complexity comes from. There's a vast kind of plethora of areas underneath a rate, just a simple rate, that need to be addressed for your company to really be compliant from a sales tax compliance standpoint. Now, number one is Nexus. Now, some of you may have heard that term previously, but for those of you who are not familiar with Nexus, Nexus is an industry term for where your company is currently obligated to be registered, collecting and filing sales tax. Now, I'm going to get into many different ways you can trigger Nexus here in just a minute, but just keep in mind that it's essentially where are you obligated right now to be registered throughout the U.S. in collecting and filing sales tax. So you have to know, right? That's really the first step in being compliant with sales tax. If you have no idea where it is that you need to be registered right now, where you need to be collecting and submitting your return, you need to find out ASAP, right? That's the first way to be compliant. Number two is, what about product and service taxability, right? Be aware of the different things that your company is selling, and be aware if they vary in taxability from state to state. As I mentioned previously, something like software, for example, or nutritional supplements, or medical devices, or a vast array of services, such as consulting or installation, things like this, the states are going to tax those types of things differently. So to give you an example, the state of California does not tax software as a service. But if you sell software as a service, that's actually what we sell. We're a SaaS company. If you sell software as a service in California, and you also sell like a warranty or some type of maintenance agreement associated with that software, the software is not taxable, but that maintenance contractor agreement would be partially taxable, right? What if your company sells medical devices, for example? You may sell into one state, and that state specifically says, we do not tax medical devices. But a neighboring state or multiple neighboring states or a state across the country where you have to collect tax, maybe they tax medical devices. So these are the types of things that you have to be aware of to be compliant with sales tax. You have to know where you need to be registered, collecting, and filing. You need to know if the products and services that you're selling are actually taxable in the first place. So number three, jurisdiction assignment. So, you know, that's sort of phrased in a confusing manner. What that really means is just the vast array of jurisdictions across the country that you'd have to manage, right? It depends on the state. As I mentioned previously, if you have a business that's based in Massachusetts and you only have to collect and file sales tax in Massachusetts, well, there's one sales tax rate in that state. It is a flat rate state. There's not a lot of complexity there, right? But if your company goes and gets registered in Texas and you have to start collecting sales tax on all your sales into the state of Texas, there are 1,600 unique sales tax jurisdictions within the state of Texas. So if that's something that you're trying to manage manually by maybe putting rates into QuickBooks or whatever platform it is that you're using to process orders, that's a very arduous task, right? A state like Colorado has over 300, for example. Washington State has over 300. California has over 300. Alabama has about 800, right? So it will depend on the state, but once you know where you need to be registered and you're collecting and filing sales tax, it's not simply, hey, it's just 8% or it's 7% or it's 5%. You've got to collect sales tax often on a state level, right? The state will have a rate, but based on that customer's shipping address, you need to oftentimes account for a county rate, a city rate, maybe local, special, or temporary taxing jurisdictions. I'll give you an example. I worked with a customer a couple of weeks ago that ships product to an address in California. It's Half Moon Bay, California. And at a specific address, they had to account for 8 different sales tax jurisdictions. Now, a couple of those were temporary jurisdictions that were only in play for about 6 months. But again, if this is a process you're handling manually, that's going to be difficult. Number 4 is exemption certificates. Now, maybe you sell a product that is then resold by other companies, right? So you sell to resellers. Or maybe you sell products to religious organizations, right? Or maybe to some type of school or educational institution. These are examples of companies or entities that would be exempt from sales tax. So you may have an obligation. Let's say that one of these institutions is in the state of Texas and you have to collect sales tax because you're registered in Texas. Well, you know, regardless of the fact that you have Nexus there, if they're tax exempt, they should be giving you an exemption certificate, right? That says, hey, I'm tax exempt for this reason. It's a religious institution, it's a school, they're a reseller. They will have documentation that they should provide you proving why they're tax exempt, and you need to keep that on file. That's a whole other layer of sales tax compliance that folks really don't think about. But if a company you're selling to says, do not charge me sales tax, I am exempt, you have to have documentation from them on file. And not only do you have to have the documentation, it's got to be accurate, right? It's got to be filled out correctly in order to be valid, and it's got to be current. So some of the states will issue exemption certificates that actually expire. And if one of your customers sends you an exemption certificate that is expired, that's a problem if you get audited. So the last 2 are really more of kind of logistics for your company, right? Just depends on how many states that you're registered in, but you may have quite a few returns you have to prepare at the end of the month or the end of the quarter. And then finally, how ready would you be for an audit, right? If the state came knocking on the door and said, hey, I need to see all of the transactions that you had over a particular time period and all the tax that was calculated on those transactions, how quickly can you access that data and provide it, right? If they say, hey, we want to see all the sales tax returns that you've prepared over the last 6 months or a year, you know, how quickly can you access that, right? Is it stored digitally? Do you have it in a filing cabinet somewhere? So these are all things to just show that really rates or calculations for sales tax, really as seen here, it's just the tip of the iceberg, right? There's a lot of different complex things going on underneath the surface that are all part of keeping your company compliant with sales tax. So let's talk about some of these challenges with sales tax compliance more specifically. I won't read off this slide word for word, but the one thing that I want to point out is kind of the second point there. There's over 12,000 taxing jurisdictions. This slide is actually not up to date, and that's on me for not updating it. There's actually about 14,000 different sales tax jurisdictions currently within the U.S. Now, a lot of these are counties, a lot of these are cities, a lot of these are local taxing jurisdictions, but there can even be temporary sales tax jurisdictions in place sometimes. So, for example, if one of these large cities around the country, I'll use Atlanta as an example. So the Braves decided a couple years ago that they needed a new stadium, right? Now, part of the way that that stadium was paid for is Atlanta instituted temporary sales tax jurisdictions for a specific time period. Now, if you're not using some type of automated solution for sales tax compliance, it's going to be very difficult to know when those types of temporary jurisdictions are in play. Now, some of the things on the slide we've already talked about, right? So, you have products and services with varying taxability. That line that says product service-based exemptions, again, it just depends on what you're selling. Sometimes a state will exempt it from sales tax, right? You can have a customer-based exemption. That goes back to what I mentioned previously. If you're selling to, a religious organization or a school of some kind, or you're selling to a reseller, there's many, many different reasons why a customer could be exempt from sales tax, but you've got to have the documentation that proves that, right? So what are the key things to know from a transaction or that are part of a transaction for sales tax compliance? Well, number one, you've got to know a lot about your customer, right? You have to know if they're exempt from sales tax, right? You've got to know the date and time of that invoice that you're creating or that order that they're placing online. The reason for that is the sales tax from today to a week from now could change drastically. That's why you need a live solution that is automating sales tax calculations for you, right? If you sell to someone in the state of California or Texas where there's all these different kind of sales tax jurisdictions in play at one address, it's very likely that you could sell to them now and a week later, one of those counties or cities or local jurisdictions could have changed, or they could have instituted a temporary jurisdiction that you're not aware of, right? Finally, the where, right? 99% of the time in the U.S., and we'll get into sourcing rules in a minute, 99% of the time the sales tax is derived from the shipping address or the destination address of the product or service that's being offered, right? So you need a destination address, right? Our solution needs a destination address as well. If we're going to calculate sales tax for you, we need to know where that product's going or where that service is being delivered. And then finally, what are you selling them? Are you selling them a tangible product that doesn't have a lot of complexity, taxability-wise? Are you selling them a service that may be taxable in one state but not in another? Are you selling them a nutritional supplement that, based on the ingredients in that supplement, is actually partially taxable in that state, for example? And that happens very frequently. So I want to take a few moments and talk about product taxability specifically, right? Being aware of what your company is selling and where it either is or is not taxable. That's really half the battle in sales tax compliance. So these are a few of my favorite kind of strange laws, if you will, throughout the country. I won't read them all, but take a look at, for example, takeout in Colorado. So if you're sitting in the drive-through line at a McDonald's or name your favorite fast food place, and you happen to be in Colorado, and you order a soda, well, the straw and the cup lid that are part of that soda are taxable items. But Colorado has decided that the cup itself is exempt from sales tax. Another good one is bagels in New York. I love this one. So if you go into a deli in New York, and I have been fortunate enough to do this, and the bagels are delicious, if you have that bagel sliced, it is taxable. If you get the bagel whole, meaning it's not sliced, there is no sales tax involved in that transaction. The reason for that is New York views a sliced bagel as having a service involved in the transaction. So you're not only purchasing a product, the bagel, you purchase a service as well, which is the slicing of that bagel. So donuts in Texas is a great one, right? If you get you get 5 or less, it's taxable. You get 6 or more, it's not taxable. And then a very strange one, and this is related to the nutritional supplement one that I mentioned a minute ago. If you buy a candy bar in Indiana, you're going to pay tax, sales tax on a Snickers, but you will not on a Kit Kat or a Twix. This is because of how the ingredients are listed on the back of that particular candy bar. I don't know the exact rule off the top of my head, but I believe it has to do with the order in which flour is actually listed in ingredients. If it's listed first, then it's taxed a certain way. If flour comes later on in the ingredients, it would be taxed differently. Now that is very, very strange, and I can't tell you the logic behind that, but this is just an example of the links that some of these states will go to make the products or services you're selling quite complex from a taxability standpoint. So let's talk about sourcing rules. Now I mentioned previously that sales tax 99 or so % of the time is going to be derived from the shipping address or the destination address of products you may be selling or services that you may be providing your customers. Now, that's not necessarily always the case for intrastate sales, meaning sales where a company is based in one state and they are shipping a product in that same state. So if you look at the column on the left, these are origin-based states for products, but they're destination-based for services, right? So if you sell them an ink pen, you're going to want to know what the sales tax is at your location. So I want to back up for a minute and explain what I mean by origin-based and intrastate sales. What I mean by this is if you have a company that is located in one of those states listed there, from Arizona to Virginia, and you are selling a tangible product, not a service, a tangible product, and you're going to ship it to a customer that's also in that state, right? So let's say you're based in Virginia and you're selling a product, shipping a product to a customer also in Virginia. You would actually have to collect sales tax based on your location, based on the origin of the product. And that's the case in all the rest of those states you see there as well. Now, what's complex is those states say that rule does not apply for services, right? So if you're an HVAC company in Virginia and you send trucks and reps out to various places in Virginia and they're going to install a unit or they're going to repair a unit, for example, you've got to then collect sales tax based on the destination address, right? So this just shows how complex this can get. You know, and a lot of times companies are selling a mixture of products and services, right? So you have to be aware of what kind of sourcing rules apply. And again, if you're not using some type of automated solution to manage this, it's very difficult. So let's talk about zip codes. Now, this is another very, very, very common response that I get when I ask folks that I'm talking to, hey, how are you managing your sales tax, right? How do you know what sales tax rate to charge for a particular customer? And usually the response is, oh, I'm using zip codes. I'm good. You know, I've got a table I got online somewhere that lists out all the zip codes in a particular state, and next to it just shows me a percentage. Well, here's the problem with that. Zip codes are for delivering mail. They are not for calculating sales tax. Now, what do I mean by that? Well, let's go back to the example I've hit on a couple times already, right? Massachusetts, for example, is a flat rate state. There is one sales tax rate in that state. So if you're using a zip code to calculate sales tax in Massachusetts, you're probably going to be just fine. There's not a way you can mess that up. There's one sales tax rate. It's going to apply to every zip code. If you're using zip codes to calculate sales tax in Texas, that's going to be a problem. The reason that's going to be a problem is, again, there are 1,600 unique sales tax jurisdictions in the state of Texas. And very often, you might have 20 or 30 of those sales tax jurisdictions in one zip code. So it's impossible to capture the complexity of all of the jurisdictions that are in play if you're using a zip code. What's very common is that folks will be using a zip code, or they may be using, for example, a competitor of Avalara that uses kind of zip codes to estimate sales tax. The issue there is there's not a way to be 100% accurate on what that calculation should be. So instead of drilling down to the rooftop, knowing that there's 3 or 4 or 5 different jurisdictions in play and saying, okay, the composite rate for everything is 7.2%, they have to go, well, there's 20 different sales tax jurisdictions in this one zip code. We can't isolate exactly where this is going, so we'll just call it 9%, or we'll call it 10% or something. So what ends up happening is a lot of these folks using zip codes are probably over collecting sales tax, right? They may not be. Maybe they're under collecting. That's also a possibility as well. But just keep in mind that zip codes are not for calculating sales tax. They are for delivering mail. There's no way to be accurate down to the rooftop and collect the correct amount of sales tax using simply a zip code. And I'm going to show you why. So this is an overhead view of a neighborhood in Commerce City, Colorado. So you'll see that there are 2 particular houses that are pointed out. So the 7450 Layden Street address, which you'll see on the left there, the sales tax is 9.25%. Now, just down the road and on the other side of the street, as you can see there's a 7495 Locust Street address. The sales tax at that location is only 4.75%. That is a delta or difference of almost 5% in terms of the sales tax, and we're talking about houses that are maybe 4 or 5 houses down the road from each other. So if you're using a zip code, right? Imagine using a zip code in this instance, right, to calculate sales tax. There's just not a way you could do that accurately. But this is also showing you kind of the absurdity of how these jurisdictions are set up. Colorado is notorious for having areas like this. I mean, and you can even see some of those houses in green or yellow, however it's coming across on your end, are just kind of lost in a sea of blue, right? Why that decision was made, I have no idea. But you know, the point is, it was made, and these are how these jurisdictions are set up. And if you're not using some kind of solution to know that, hey, this house is 9.25%, and 4 or 5 houses down, it's 4.75%, it's going to be a difficult task. So let's talk about Nexus. At the very beginning of the presentation, I talked about how Nexus is an industry term for where you are currently obligated to be registered, meaning which states. And if you're in a state like Colorado, or you're in a state like Louisiana or Alabama, you might even have to be registered in some local jurisdictions in those states, for example. But it's where you're obligated to be registered, collecting, and filing sales tax. There's many, many different ways that you can trigger Nexus, right? The most common way is to have a substantial physical presence in a state. So if you're a company, and let's say that you're based in Florida, for example, you've got a physical location there, maybe a warehouse, you've got an office, you have employees in that state, that is a physical presence. You're going to have Nexus in the state of Florida, so you should be registered there, and you should be collecting sales tax on all of your sales that are in the state of Florida, right? And you're going to submit a return to the state of Florida reflecting that tax you've collected over a specific time period as well. But what happens when you have sales reps, for example, that travel outside of the state of Florida? And maybe they go visit prospective clients in other states. Maybe they go to trade shows in other states. Maybe they just go to, to events that aren't necessarily trade shows, but they're doing activities for your company. That's typically going to trigger Nexus. So if you have a traveling sales force, or even folks who are not doing sales, for example, I had a customer a couple months ago whose company had a board member that was located in another state, not doing any kind of sales activity, but that board member created Nexus for them. So they had to go get registered in the state where that board member was located. You'll see a lot of other ways that you can create Nexus on this list, right? Inventory. So do you have product that is stored in a warehouse in other states? If you do, you very likely have Nexus in the states where that inventory is stored. Now, who do you think that affects greatly? Amazon sellers, right? Amazon sellers who are participating in the FBA program, meaning Amazon is not only providing a platform for an order to be placed, they are also storing your product, and they are fulfilling the orders when your customer places an order. What that means is they've got that product stored in warehouses across the country. Amazon has fulfillment centers in close to 30 states. I think it's about 28 states currently. So if you participate in Amazon FBA for sometimes not even a very long time, you'll have product that gets moved throughout all these different warehouses, and that creates Nexus. A lot of marketplace or Amazon sellers out there that are not aware that their products being stored in this vast network of warehouses is actually creating a sales tax obligation for them in a bunch of those states. So affiliate Nexus, the one on the top left, is an interesting one as well. An example of affiliate Nexus is click-through Nexus. Now, for those of you who've never heard of click-through Nexus, that would be like if I had a website, for example, and I went to another company and I said, hey, I would like to put a link to my website on your website, right? And I'll pay you a commission for that, but we sell kind of related products or we're partners or whatever it may be, and I just want to drive some traffic from your site over to my site. What happens is folks go to my partner's website or that other site, and they click on that link and they're directed to my site. Well, that creates what we call click-through Nexus. And it could potentially, depending on the state where that partner is located or that other company is located, if that state has a law for click-through Nexus, I may have to go get registered in that state and collect and file sales tax, even though I don't have any kind of physical presence in that state. Simply through that affiliate relationship of driving traffic to my website through a link, that could potentially create Nexus. So let's talk about how Nexus has changed, specifically in the last few months. Now, what I just talked about was creating Nexus through a substantial physical presence, or maybe through an affiliate relationship that your company has. Well, a couple months ago, the Supreme Court ruled on the Wayfair versus South Dakota case. Now, I won't get too far into the weeds about Wayfair versus South Dakota, but essentially, a couple years ago, South Dakota went to the company Wayfair, and I'm sure you're all familiar with Wayfair, and they said, hey, you're selling a ton of product into our state. And even though you're not physically located in the state, we're going to say that you have to get registered. And when you ship a product into our state, there needs to be sales tax involved in that transaction. Well, Wayfair obviously wasn't too thrilled with that, so they pushed back. And there was enough pushback to where this eventually got in front of the Supreme Court, the United States Supreme Court. And after some deliberation, the Supreme Court ruled in favor of South Dakota. What that means is it is now constitutional for a state to say, even if you do not have a physical presence within our borders, you may trigger Nexus through crossing some type of economic threshold. And you'll see those economic thresholds in that first paragraph. Most of the states that have an economic nexus law to this point, and you see them highlighted in blue on the map, most of them have adopted at least a $100,000 total sales or gross revenue threshold, or 200 or more unique transactions or separate transactions, right? So basically, if you have a certain amount of sales into a state, or you have a certain number of individual transactions that result in that state, you could potentially trigger Nexus in additional states. Now, what that means is if you're a company that just ships a couple products here and there and you just have an order every now and then that goes into another state, unless you're selling a medical device that's, $1 million or in this case, $100,000, you probably don't have a lot to worry about, right? But if you're a company that's kind of ramping up your interstate sales and you think, hey, yeah, we're going to do at least $100,000 in total sales in a number of these states. Or yeah, we don't have high ticket items, but we do pretty high volumes in terms of number of transactions, right? So if that's the case, you now want to be aware that many of these states have passed these thresholds. And once you cross over that $100,000 in total sales or the number of unique transactions, you need to get registered because that will create Nexus for you. Now, what I want to point out specifically is only about 23, 24 states have reacted to the Wayfair decision. So those states that you see in blue there, there will be a number of states that will pass similar laws, most likely early next year, right? We don't know the exact ETA. We'll have to wait till their legislatures get back together. But they very likely will adopt similar thresholds as these other states. And this is probably too small for everyone to see on the presentation, but we'll make sure that a copy of this is available. These are some frequently asked questions about kind of the impact of the Wayfair decision. But what I want to highlight is kind of go back to, for example, Amazon sellers, right? So the reason that selling through Amazon FBA, for example, what we talked about previously, is complex is because you send your product to Amazon, and Amazon then moves all of that product throughout the country to be stored in their various the various fulfillment centers that they have. And it's about 28, 29 states that are included, right? So that's creating a physical presence nexus. Well, another thing that Amazon sellers have to be aware of now is outside of these states where they may have a physical presence, they have to look at their sales volumes, right? They have to know, hey, how much am I selling into this state? Am I going to cross over this total sales threshold? How many unique transactions do I have that are resulting in this state? Does that cross a threshold, right? So there can be additional nexus created by these economic thresholds that are now in play. And what we're recommending, we're highly recommending, is that every company that's doing interstate sales, right, that's shipping a product across state lines, start sorting all of your sales by state, right? You want to be aware of what your volumes are, how much in total you're selling into a particular state, how many transactions do you have. And when you want to get registered is still, kind of up to you. Obviously, when you cross one of these thresholds, you have to get registered, right? The states have said that. However, you can also register ahead of time, right? So a lot of the feedback that I get about Wayfair is, well, I don't want to have to track all of my transactions down to the penny, and I don't want to have to track all of my unique transactions and know exactly when I have my 200th transaction and go get registered, right? Well, that's fine. What we recommend is start sorting your sales now, right? Maybe even look at historical data. If you've got your total sales from 2017 and you can break that out by a state, then use that information as well. But certainly you can look at some of the states where you have the highest volumes, and you can put those at the top of the list. And you can say, hey, I haven't crossed the threshold yet, but I know I will here in the next couple of weeks or the next couple of months. Why not just register ahead of time? There's no penalty. There's nothing wrong with kind of voluntarily registering with the state ahead of time, and that way you don't have to worry about it, right? But just be aware that Wayfair or the Wayfair decision has drastically changed Nexus. It hasn't gotten rid of physical presence Nexus. Physical presence Nexus is still very much in play, but it's added another test. You have to know what your total sales are in the states now, how many unique transactions you're having, and then how that's impacting your Nexus footprint. Again, this is a visual representation of all the different states where Amazon has an FBA warehouse. I'm not going to spend too much time on this slide because we've already talked about it, but just be aware that if you are participating in FBA, you very likely at some point could have products stored in warehouses in 25 or more states. And if you have a physical presence in a state, that's still very much a slam dunk Nexus trigger. So this is a study that came out in 2017, so it's a little bit older, but I think the content is still very much relevant. When companies are asked about their internal processes, 3 out of 4 folks will say in the finance department that if they're audited, they're very likely to find mistakes. So I want to take a moment and thank everyone on the call today for using Avalara. What do I mean by that? Well, did you stop on your way to work, for example? Did you buy a coffee? Did you also fill up your car with gas? Did you make a few calls on your cell phone? Did you go by one of those New York delis, for example, and get some bagels? And remember, did you get less than 6 or more than 6? Because in Texas, that matters, right? Or did you, I'm sorry, well, that's for donuts, not bagels specifically, but you get the idea. What about sliced or whole? So if you're in New York, if you went and got a bagel, did you get it sliced? Or did you get it whole, right? That affects the taxability. But again, I want to thank everyone for using Avalara. Well, what do I mean by that? Well, what I mean by that is Avalara is going to calculate more than 6 billion transactions this year. So most days, you're probably going into an establishment of some kind and making a purchase, and Avalara is the one that's calculating the sales tax on that transaction. You probably didn't even know it. So let's talk about our product. So again, we're a SaaS company, software as a service. We have a cloud-based tax engine that is our core product, and it is called AvaTax. Now, it currently integrates with about 650 named systems, right? So I mentioned previously platforms like QuickBooks, whether it's desktop or online. We'll integrate with inventory management systems like Fishbowl, for example, a wide array of e-commerce shopping carts. If you're using something like Magento or WooCommerce or BigCommerce or 3D Cart, for example, and then also enterprise level ERPs, right? So if you have Salesforce on the back end, or you have Oracle or SAP, for example, or NetSuite, these are all things that we can integrate into. What you're seeing here visually represented is an invoice within QuickBooks. Now, and I'll use that as the example for this presentation, but our software, you can think of it as a plugin or an extension for QuickBooks. It will integrate and take over all the native functionality for sales tax as you're creating invoices. Now, your process in terms of selecting your customer, adding items to the invoice is not going to change. What's going to change is when you save that invoice, if the destination address of those products and services falls in a state where you have to collect and file sales tax, there is a call from QuickBooks to our tax engine. And in 0.2 of a second, we are able to determine all of the sales tax jurisdictions that are in play at that particular address. Now, again, if it's the state of Massachusetts, there's one rate in play, right? If it's a state like Texas or California, there could be 6 or 7 at a particular address. That's what our software is doing in a split second. You can see the call out to the cloud, right? That's representing our product. And kind of the courthouse or whatever you want to call it that's down at the bottom in black, that's just representing all of the state's rates, rules, and boundaries, right? Our software is referencing current rates, rules, and boundaries when it's doing this split-second transaction, or the split-second calculation, I should say. Now, all of that content, meaning all these different rates, for example, or the different jurisdictions in the state, or the different taxability rules, right? Knowing whether software is taxed here and is not taxed there, knowing whether a nutritional supplement is taxed here but not taxed there. All of that content is what we keep up to date on the back end, right? So if you invoice a customer today, there's going to be one sales tax that's returned to the invoice. You might invoice that same customer next week. The sales tax may be different because some of these rates, rules, and boundaries have changed, and we've updated that for you. So what goes into kind of an AvaTax decision, right, when we do a calculation? Well, number one, we're going to validate the address. When you save an invoice in QuickBooks, for example, we're always going to cross-check that address with the USPS database to make sure that it is the proper address, right? If you put in street and it should have been lane, for example, that's the kind of thing that we want to correct. If there's only a partial zip code in there, for example, we want to correct that. Why do we want to correct that? Because we do a lat-long conversion. When we see a shipping address on an invoice, the way that we are able to determine all of the jurisdictions in play at the rooftop of that address is because we're converting it to lat-long and literally drilling down to the rooftop. We referenced your Nexus profile. Well, what are the states where you have to collect and file? That's what you have to tell us kind of on the front end when you're setting up the product. So if you create an invoice for a customer in North Carolina and you don't have Nexus in North Carolina, you don't need to collect any sales tax or remit anything to North Carolina, then our tax engine will do nothing for your North Carolina transaction. But if you have Nexus in California and you invoice a customer there, we'll know that's a Nexus state for you, right? Because you've told us up front. So our software will step in and will do a live tax calculation. What are some other things built in that are helpful? We know when all the tax holidays happen, right? That's something that you would not have to manually manage any longer, right? We know when different thresholds are in play. So look at the state of New York, for example. If you're a company that sells apparel and you sell it into the city of New York City, there is an apparel threshold there in terms of sales tax. If you sell one item of clothing and it is under $110, there's no sales tax involved in that transaction. If the item of clothing you're selling is over $110, there is sales tax involved in that transaction. Those types of thresholds are built into the content of our software. Then finally, exemption certificates. I won't spend too much time in this presentation, but just be aware that we have an extension of our software that can manage all of your exemption certificates. So if you're a company that sells to a lot of resellers or a lot of organizations or institutions that are sales tax exempt, and maybe you have a couple hundred or a couple thousand certificates on file at any time, well, the issue with managing that many certificates manually is that many of those certificates are going to expire within probably the next 60 or 90 days, and you're probably not even aware of it, right? You may have also received certificates from your customers that aren't filled out correctly. And if you have a certificate on file that's not filled out correctly, it's invalid. Meaning if you got audited, the penalty would be the same as if you didn't have the certificate to begin with. So if you're a company that has a lot of certificates and you want help managing those, automating that process, that's also something that we do. So this is a visual representation of I already mentioned the 600 plus different platforms that we can integrate with. Now, point of sale systems, right? In-store sales, e-commerce, folks selling online, and then, CRMs, ERPs, right? Just a few more. Now, how easy is it to set up AvaTax or to implement our solution? It really just depends on the platforms that are in play, right? So I'll be the first to tell you that if you're going to plug our solution into QuickBooks, it's going to take less time and require kind of less, I guess, implementation support than say an integration into NetSuite would, for example, right? But using QuickBooks as an example, we've been partnered with Intuit for a long time now, over a decade. And our integration for QuickBooks is very easy to use, it's very easy to install, and it's something that can usually be done within an afternoon. It's not something that's going to take you weeks and weeks and months to implement. But the key things that you're going to tell us during the setup is, we want to know, where do you have Nexus, right? What are the states where you need to collect and file? So our software knows when you save an invoice, do we need to hop in here and do a tax calculation or not, right? We also want to know what's being sold. Now, if you sell tangible personal property, something like an ink pen, there's not a lot of complexity there, right? You can say, hey, I sell tangible property, that's it. It's either fully taxable or not, and we'll go from there, right? But if you are a company that sells software or nutritional supplements or you're a service-based company, we want to know what's being sold. We want to know those items that will show up on an invoice so that we can tax them properly. Finally, and I haven't talked about this piece yet, but we can also prepare and file returns. So if you get the end of the month or the end of the quarter in particular states and you want to outsource that to us, you absolutely can. We'll prepare returns based on the transactions you've had and the tax that we've calculated. We'll prepare the returns, we'll file them on time with the various states automatically, and we can even remit the tax that you've collected over that time as well. We typically just ask you for access to an account that we can do an ACH pull from. But at that point, it is a full sales tax compliance solution. We're going to calculate all your sales tax, we're going to prepare all your returns, we're going to file those returns, and then we store everything digitally as an audit repository. So if you get audited 6 months from now, or a year from now, or 4 years from now, whenever it is, there will be a digital record of all the transactions that you've had and all the tax that was calculated. There will also be a digital record of all the returns that we've prepared for you and that we've filed for you over that time. We find that a lot of our customers say that audits go by a lot quicker and a lot more smoothly when there's a solution like AvaTax in place. So how can you reduce risk moving forward, right? Number one, evaluate where you have nexus, right? This is where I started the presentation. If you don't know as of right now where across the U.S. you need to be registered and collecting and filing sales tax, then you need to find out as soon as possible. That is the first step in being compliant. Number two is, how confident are you that the platforms you're using are actually calculating sales tax correctly, right? So if you use something like QuickBooks or any other platform and you sell to a customer that's in Texas, are you manually going in and updating 1,600 different sales tax jurisdictions, especially as they change sometimes from week to week or month to month? So I won't read, through all the rest of these, but the point is, in evaluating your sales tax footprint, what we stress is you have to be aware of where you're obligated to go register, collect, and file, where you have a nexus. And you have to be aware of, is the product or service that you're selling, or products or services, how are they taxed from state to state? Are you selling an ink pen or are you selling software? Because those two are going to vary drastically in terms of their taxability rules from state to state. So that is what I have today. Again, I want to thank everybody for joining the call, and I'll hand it back over to you, Jennifer.
Mark, thank you so much. That was really an excellent presentation. I know I learned a lot, so I hope everyone on the line was able to pull some bits of information to apply to their businesses as well. So I will just remind everyone, if there are any questions, go ahead and chat those over to us. None actually came in during the presentation, so I think it was just really a lot of information and really well delivered. So thank you so much. But like I said, I'll give everyone just a minute here to see if any questions come up. Otherwise, that'll pretty much wrap it up for us today. Matt or Mark, if you had any kind of last minute comments you wanted to share before I take the screen back.
Yeah, the last thing I would say, the most calls that I'm getting recently are surrounding the Supreme Court decision related to Wayfair. And there are a lot of small businesses specifically who think that, that means that they're going to have to go register in every single state, immediately, and they're going to have to start collecting tax on every sale. My comment there would be that's probably not the case, right? As I mentioned, there are significant thresholds in place. If you're selling a few orders here and there into other states, it's very likely that you won't create that obligation. Now, obviously, if you're a company that has high volumes into other states, you really need to start sorting your sales by state and being aware of what your volumes are to see if you're crossing those thresholds. And that's something that we can help with as well. So if you want to start with, hey, let's just look at where I have nexus, give us a call. We can help out. But that would be my final comment. And I thank everyone for their time, and as well as you, Jennifer, and Out of the Box as well. We appreciate you having us.
Thank you so much. And as you mentioned, the Wayfair versus South Dakota, when we had Matt on a couple of months ago, he really did touch deeply into that. So anyone on the line who does want more information, we do have that recording on our site as well. So in just a couple hours, everyone on the line here will get an email with a link to the recording of the session. So if you wanted to watch it back, revisit anything, and I'll also include a link to that other Avalara presentation so that you can have both of those resources right there for you at your fingertips. So And I know, Mark, you showed that FAQ page, so I'll make sure to get a PDF of that from you if you don't mind, and we'll post that up so people can have that information too.
Absolutely. I'll send that over as soon as I can after the presentation.
Okay, great. All right, well, I'm going to go ahead and take the screen back here. I just wanted to tell everyone about a couple upcoming Technology Tuesdays we have to close out the year. Mark had mentioned actually Amazon sellers and how taxes can be, kind of interesting and all over the place depending on where you're selling to or selling from. Well, in 2 weeks, we have a webinar on a time-saving tool for Amazon sellers, not tax related, but just a tool for them to make their processes easier for payments and all of that. It's A2X. They were a fellow top 10 app winner with us with Intuit in 2017. So we're excited to have them on with us. And then we'll close out the year with some new features on Recur 360. And then Out of the Box Technologies co-founder Lisa McCarthy is going to do a presentation on what's new in QuickBooks 2019. So feel free to join us for that. Again, all of these are completely free to watch, and they're also recorded and posted to our site. So if you miss one, you can just jump on and watch that at your leisure. If you wanted any more information about today's presentation, any of our Technology Tuesdays, or just Out of the Box in general, feel free to shoot me an email or visit our website, outoftheboxtechnology.com. And that pretty much wraps it up. So I echo Mark's thanks to everyone who is here online with us, and we hope to see you again soon. Thanks so much.